Hello, this is Mijun from the University of American Knowledge Theory. Let's begin today's American Knowledge News for September 26th. Welcome back to Mijun, where we always focus on the basics of investing in United States stocks. Another great weekend is here. I'm also someone whose mood changes a lot depending on the day of the week. So when Friday comes, I somehow feel more relaxed and just happier for no particular reason. But when we work hard at investing like we do, there are days when, depending on the stock market's mood, even Friday doesn't feel good. Today, it's probably because the United States stock market has been sluggish all week that you still don't feel the weekend mood, right? And especially recently, after hitting bottom last April, the United States stock market has been on a wild rally for about 5 months. Because of that, we've seen a lot of beginner investors who have recently entered the United States stock market. And since experience is the most important thing when it comes to investing, for those who lack experience, when stock prices fall like this, they tend to go through a tough time emotionally. So today, I've prepared a small message for those people, hoping they can start their weekend in a better mood. Let me explain using the chart. Recently, there have been messages saying that the United States stock market is going through a correction, that stock prices are dropping a lot, and that it's a big problem. But if you actually look at the stock chart, you can clearly see the current situation. The S&P 500 chart you're looking at right now is not a 10-year chart, but a 1-year chart. It's a 1-year chart. If you look here, you can see that the stock price dropped from here to here. It dropped so slightly that it's barely noticeable, but even this small drop is causing some people to worry. Now, there's one thing we need to remember. We're investing in the stock market, which we call a risky asset, and the word risk is the same as volatility. If we understand this volatility when we invest, we can feel more at ease. But for those who don't like this volatility, they usually choose to put their money in savings. When we go to the bank and make a deposit or open a savings account, the annual return is usually about 2% at best, right? Now, normally we should be satisfied with 2%, but if you invest in the United States stock market, it gives you an average annual return of about 10%. That's been proven throughout history, hasn't it? And if we muster up a bit more courage and get a little more ambitious, building a portfolio focused on tech stocks can yield up to a 20% average annual return in the United States market if conditions are favorable. Now then we need to take a moment and think about this. Originally, we were supposed to make about 2% annual returns, but instead of 2%, we're investing in stocks to make about 20% returns, which is about 10 times more than that, so we have to pay for that. You need to give up something to increase your returns by about tenfold. So, if you invest in the stock market instead of putting your money in savings, how should you pay the price for that risk? This is the psychological anxiety. So when we come to the United States stock market and invest, we're investing in risky assets. And the risk we're talking about here is volatility. So it's not linear. There are ups and downs. It's the same even if you look at the 1-year chart now. Let me show you some patterns from the past. History always repeats itself, right? So it's very reasonable for us to predict that what happened in the past will happen again in the future. If you look at the stock price chart over the past year, it goes up and down, up and down, up and down, up and down, up and down. It's repeating this pattern of rising and falling at almost regular intervals. But if you look at this part of the chart, in the second half of the year compared to the first half, you can hardly see those ups and downs anymore. That's why over the past 4 or 5 months, I've been showing you the Volatility Index chart. I've been telling you that for a very long time, the Volatility Index has stayed below the 200-day moving average. Looking at historical statistics, I've repeatedly said that the current market is very unique. We can check that for ourselves right here. But the problem is, this is an abnormal market. In a normal market, this would be the standard. If you look here, it keeps going up and down repeatedly, and you can see that it drops and rises by at least 3% to 5% each time. This cycle should keep repeating. But recently, that hasn't happened. That's why it seems like our immunity has weakened a bit. That's why recently, even if it dropped by just about 2%, people are feeling heartbroken, struggling, and getting stressed out. But when we look at past stock charts, we need to remember that this kind of drop is actually normal and it can fall much more than this. And right now, you can see this orange line here. This is the 20-day moving average. As you can see, the 20-day moving average has consistently acted as a support line. When the price goes up and down, the point where it keeps bouncing back up is the 20-day moving average. And right now, the current stock price has dropped down to the 20-day moving average. The current price is 6,604 and the 20-day moving average is 6,561. If it drops a bit more, it will hit the 20-day moving average. Whether it bounces back again from here, or if it fails to rebound and keeps falling, if it breaks below the 20-day moving average, then this time, we can expect the zigzag pattern to go even deeper. Alright, let me show you here. When it breaks below the 20-day moving average, it tends to drop a lot. There were cases where it dropped this much, and here too, when it broke below the 20-day moving average, it fell a lot. It's the same here. It dropped a lot as well. At one point, it even dropped by 18%. So when the stock price suddenly drops by 18% in a short period like this, if I remember correctly, in my portfolio, Mizuhome portfolio, about 300 million won suddenly disappeared. But if you give in to this kind of volatility, you end up leaving the market after losing 300 million won, and then you can't enjoy the rebound that follows. So you need to understand that volatility is natural, and I really want to emphasize how important it is not to be swayed by volatility. Even if the price drops below the 20-day moving average, remember it has rebounded before after similar falls, so if you wait a bit, it may recover again. I want to convey the message that it's really important to invest with this kind of belief. Kong. Now today's Friday, so today I'd like to share a bit of a personal story. Yesterday, we hosted a special live broadcast with Choice Stock Chief Executive Officer Mr. Kim In-jung. So did you watch the live broadcast? Someone left a comment here, a person using the identification Kim Wonseo. They said, I know Mr. Kim In-jung from Choice Stock, but what is Mijun's real name? I'm curious. Those who have been on the Mijun channel for a long time probably know my name, but since there are many people who have recently become familiar with Mijun, I think I should introduce myself. My name is Choi Cheol. So if you go to Naver and type in Choi Cheol, and maybe try typing in Mijun as well, you'll see a lot of articles and information related to me come up. But if you look, most of it is about books, so it's not very interesting. So instead of searching for Choi Cheol or Mijun, type in Choi Cheol Hotelier, since I worked as a hotelier for a long time. You'll actually find a variety of information here that will help you learn a bit more about me. So you'll also see some of the photos I took in the past. So you'll get a chance to understand me better, like, oh, this person used to do this kind of work before becoming an influencer. If you're interested, please go to Naver and search for Choi Cheol Hotelier. And if I could recommend an interesting video for this weekend, my husband, he's a YouTuber, and now let's try searching for Mijun next to it. So if you go to YouTube and type, my husband is a YouTuber, Mijun in the search bar, you'll probably see me appear at the very top. So, you'll see something like a YouTuber husband's life from his wife's perspective, Mijun, come up. This is a video my wife uploaded about 2 years ago. Retiring with United States stocks? Not the Mijun channel, but if you look here, there's another channel called Korean Nomad Family. It's a pretty small channel, but it's actually been around for quite a while. It's an old channel, but it doesn't have that many subscribers. So far, only 6,280 people have subscribed to this channel, and there are only 149 videos right now. But if you're curious about what kind of person this is, come to Korean Nomad Family and watch some videos, especially the one my wife uploaded called My Husband is a YouTuber. It's a short video, so if you watch it, you'll nod and think, so this is what Mijun is like. Now, I'd like to give you a brief announcement as well. Choice Stack is offering a surprise discount right now. If you sign up this time, you'll get a lifetime 50% discount, but this offer ends today, Friday. However, since Chief Executive Officer Kim In-jung mentioned yesterday that the offer could be extended over the weekend, I want to emphasize that if you can't sign up by Friday after watching this broadcast, you can still sign up during the weekend. And yesterday we had a live broadcast with Chief Executive Officer Kim In-jung. At the end, he announced some incredible news. If the stocks you're investing in suddenly surge or plunge rapidly, you get very curious. You can't help but wonder what happened for the stock price to drop so much all at once, or to rise so much all at once. Yesterday, Chief Executive Officer Kim In-jung said that soon a new feature will be added. And what is it? It's about the stock prices of the stocks you've added to your watch list. If the price drops by more than 5% or rises by more than 5%, they plan to introduce a new service that analyzes the reason and delivers it to you. I feel very proud because it seems like the features of Choice Stock are improving day by day. And on the other hand, I think it will also have an impact on the Mijun membership that I am running. Now, if Choice Stock continues to deliver such fast news with the help of artificial intelligence, I think the content of the Mijun membership that I am running should compete not in quantity but in quality. So as I mentioned before recently, it takes me about an hour just to write one Mijun's word. So I want to tell you again that I'm writing each one with great care, like I'm writing a thesis. All right, let's begin by reviewing the current United States stock market situation. So yesterday, there was a lot more red in the United States stock market. Overall, among the 500 S&P 500 companies, the number of stocks trending downward far exceeded the number of stocks that were on an upward trend. That's how you can see it. This means the market's breadth has likely narrowed significantly. Now, it dropped to 47.7 yesterday. It was over 53. So, for the first time in a long while, the percentage of stocks trading above their 50-day moving average has dropped below 50%. That means in the short term, there are actually fewer stocks with a good trend than those with a poor trend. And therefore, this should be interpreted negatively. Of course, it's still maintaining a very high level based on the S&P 500, but nevertheless, there are now far more stocks showing a downward trend. We need to remember this. The good news is this. If you look at the long-term trend, the 200-day moving average, which represents the long-term trend, shows that as many as 59% of stocks are still maintaining an upward long-term trend. This part can be interpreted as very positive. Next is the volatility index. The volatility index has risen to 16.74. It had been at 15 recently, so 16.74 is the highest level in the past few days. However, the 200-day moving average remains at 19 or 18. There's still some room left. So it's true that the trend doesn't look very good. It's true that we're seeing a short-term correction, but based on the indicators, there are several reasons why we can't say the upward trend has completely collapsed. Now, next is the fear and greed index, and it's really interesting. Don't view the fear and greed index as just a number. If you click on the timeline next to it, you'll see, I've always told you this, the fear and greed index. When it exceeds the box range, it becomes a negative factor. I've explained this. If it goes over 75, that means the market is excessively euphoric right now. And another thing, if you look down here, 50 was one of the indicator lines. As the fear and greed index dropped and neared 50, it kept rebounding each time, like here, here, and here. Now, this time, as a correction finally happened, the fear and greed index has fallen below 50. It's dropping close to that level. So if this time it doesn't bounce back at 50 and instead breaks through 50 and drops to 45 or 40 falling sharply like that, that means this correction is real. If things go badly, we could see a correction close to 10%. So it's possible to interpret it as, let's mentally prepare ourselves. Next is the market score, which has dropped significantly. It used to stay around a 79, 80 or 81. When it reaches 75, that's exactly halfway between greed and excessive desire. So looking at various indicators right now, it seems clear that the short-term trend is not good. So the short-term momentum has weakened, but in the mid-term and long-term, it's still a bull market. So we need to see whether this time it will end with a very mild correction or if we'll see a deeper correction. I'll wrap it up here. Now, lastly, this is the American Association of Individual Investors survey. It's released every Thursday. The numbers are the same as last week, both last week and this week. 41.7% of investors have a positive outlook. And this figure is actually better than the historical numbers. Well, I think this is due to the interest rate cuts. Since interest rates are falling, over 40% of investors expect the United States stock market to rise in the next 6 months and are making this prediction. Now, on the other hand, if you look at this red line, you'll see that the numbers have changed quite a bit. Last week, 42.4% of participants had a negative outlook, but now that number has dropped below 40%. Of course, the historical average is only 31%. What that means is, compared to the historical average, there are still a lot of investors with a negative outlook. So if we interpret this part a bit, right now, the number of people expecting a rise and those expecting a fall is almost the same. Finally, there are now a few more people betting on a bull market. So those betting on a bull market probably bought a lot of stocks, and those betting on a bear market probably sold their stocks, right? So even though the balance of power is pretty even like this, the number of people buying stocks is gradually increasing. In the short term, a correction is possible. Still, with over 39% of people not owning stocks, what does that imply? If stock prices fall significantly, plenty of money is still waiting to be invested. With so much cash on the sidelines, in my view, I personally think it's going to be very difficult for this correction to drop more than about 10%. Of course, even if the index drops by just 5%, our portfolio can drop by about 20%. We definitely need to take this into account and be mentally prepared for it. Today, for all of you heading into the weekend, we are offering the Michon Care service. So, to help you feel a bit more at ease, I'd like to introduce a recommended piece of content. The article's title is "Thanks to Good News, the United States stock market fell yesterday," which sums up its content. So what happened? The major indexes faced selling pressure and stock prices actually fell after jobless claims decreased, and the second quarter gross domestic product was revised upward. The Nasdaq Composite Index fell by 0.5%. The S&P 500 was also down 0.5%, and the Dow Jones closed down 0.3%. So even though we heard such good news, jobless claims actually dropped and gross domestic product was better than expected, which means the economy is doing well. Nevertheless, I'll explain my personal opinion on how we should understand the fact that the United States stock market actually fell despite all this. After jobless claims decreased and the second quarter gross domestic product was revised upward, the United States stock market actually declined. That's because the main factor driving the recent rise in the United States stock market was the expectation of a Fed rate cut. That's the decisive factor. If the United States economy continues to show strong performance, there's also a possibility that inflation could rise again. And even if that's not the case, the Fed might not cut rates as much as the market expects in the future. That's why the United States stock market reflected this negatively yesterday. You can interpret it that way. The cryptocurrency most closely related to interest rate cuts, it was especially volatile. Looking at that, you can see the stock market fell yesterday over concerns about interest rate cuts. I've repeatedly said many market participants engage in short-term investments, and this is important to remember. From their view, there was a chance to take profits, that's how you should see it. However, the reason why a rate cut is considered good news isn't limited to the fact that the value of future cash flows increases and stocks become more attractive. The reason we're waiting for a rate cut isn't just because of this one thing. The reason why a rate cut is important is that it ultimately helps the United States economy remain solid. And for American companies, it's a positive factor for growing their earnings, especially for those with a lot of debt. Their interest expenses fall and lower rates increase money in the market. When that happens, both consumers and companies have more money, which stimulates the economy. So American companies' earnings are bound to go up. That's why we're waiting for interest rate cuts. But yesterday there was an announcement, not about an interest rate cut, but news that the economy is doing well. The decline caused by the United States economy being healthier than expected is very unlikely to last for a long time. Of course, this is based on the assumption that inflation doesn't surge again. So, in my opinion, in the end, the market also knows very well that the decrease in unemployment claims is a positive sign, and that the upward revision of the second quarter gross domestic product is also a positive factor. That's why, in the end, this downward trend can't last for a long time. That's the conclusion I've come to. Of course, if the United States economy continues to be excessively strong, there's a possibility that the number of Fed rate cuts we were expecting could decrease. And there's also a possibility that the pace of implementation could slow down. But even if this situation does happen, I don't think it's necessarily a bad thing. For example, if they planned 3 rate cuts but only did 2, or if rate cuts were to finish in 2 years but took 3, that's the scenario I'm describing. I actually see this as a positive sign. If the United States economy is solid, and even though it's slow, the rate cut cycle gets prolonged, it can actually lay the foundation for a longer bull market in the United States stock market. A prolonged rate cut cycle means that the bull market can last that much longer, so it can be interpreted positively. In other words, the timing of the next bear market could be delayed. Originally, it was expected to come around 2027 or 2028, but now it might not come until around 2030. There's nothing better than this, so what's important isn't the corrections that happen in between. How long can the United States stock market maintain an upward trend without a bear market? If you focus on this, it's right to interpret the good economic news from yesterday simply as good news. Today, September 26th, the Fed's preferred inflation indicator, core personal consumption expenditures, will be announced. Now, if inflation doesn't accelerate again and the United States economy shows healthy signs, a bear market happening during a rate cut is very unlikely. We saw this once in April. Corrections like this, which aren't bear markets, are actually opportunities. And in my personal opinion, the deeper this correction gets, the more we should see it as an opportunity to increase the number of stocks we own at a lower price. You can now view United States stock top picks performance on screen. If you look at the very top, the stock that dropped the most yesterday was ProShares Ultra Ether Exchange Traded Fund, which fell by 12%. Following that, the Bitcoin Exchange Traded Fund B2 also plunged by 7.25%. Recently, there was talk again about interest rate cuts, so it doesn't really make sense why cryptocurrencies are falling. So today, I'd like to talk a bit about this topic. This article is a special content by Mijun. What that means is it's an article I wrote myself. You can think of it that way. I've titled it, "The Reason Why Cryptocurrency is Falling Even with News of Interest Rate Cuts." Despite the Federal Reserve cutting interest rates recently, the cryptocurrency market remains weak. Especially Ethereum has dropped below $4,000, hitting its lowest level in almost 7 weeks. So, since I also recently started investing in Ethereum, I'm really feeling this time that Ethereum's volatility is much greater compared to Bitcoin. To put it simply, as I mentioned earlier, an interest rate cut supplies liquidity, meaning there's more money in the market. When that happens, asset prices inevitably go up. That's the usual formula, but right now that formula isn't working. So I kept looking for articles worth sharing with you, but I couldn't find any that were well organized. So I applied this article, gathered several articles, pieced them together, and wrote this post. That's how I can explain it to you. So in conclusion, there seem to be several complex reasons behind the recent weakness in Bitcoin and Ethereum. The most important thing is that there's something shaking up the market in a big way, and that's large-scale leverage liquidation. Why is leverage liquidation important? Both Ethereum and Bitcoin have a very young investor base. Young investors use a lot of leverage, meaning they invest with borrowed money. The problem with investing with borrowed money is this. If the price drops to a certain level, a margin call happens on the leverage position. When a margin call occurs, you have to pay it back, so you have no choice but to sell to cover it. That's why the cryptocurrency market is very active with high leverage trading through derivatives, and with leveraged investments, even a small drop in price can trigger a chain reaction of forced liquidations. So what we can see this time is that Ethereum, especially among cryptocurrencies, is extremely sensitive to momentum. We should remember this after the market closes. There was an article related to this. According to a report by a media outlet called Business Insider, billions of dollars worth of long positions were recently liquidated. Because of this, selling pressure exploded, and the problem is that when this kind of selling pressure leads to a downward trend, it causes additional liquidations, which then lead to even bigger declines. Momentum takes a long time to recover once it turns negative. On top of that, I see another problem as well. Reports show a clear outflow of funds from institutional investors who had been consistent buyers until now. Large-scale selling occurred as rotation happened among spot ETFs related to Bitcoin and Ethereum. This also further dampened market sentiment. Bitcoin and Ethereum prices have been doing really well until now. So, the fact that there was a rotation means that investors with a short-term perspective moved their funds to other areas. That's how you should see it. But when stock prices drop because of this rotation, eventually, when the prices fall, people will come back in. I think it's important to remember this. According to what the media outlet Bitcoin Market says about this, institutional inflows cooled off during this downturn. Technical signals indicated short-term pressure. Now, what it means when technical signals aren't good is this. Major support levels were broken, so additional stop losses and delays in new buying inflows accelerated the downtrend even further. So, when a support level is broken, from the perspective of technical investors, it's necessary to be cautious for a while. So, you can see that various factors are working together in a complex way. That's not all. While unlikely, the chance of a United States government shutdown is rising. According to the decentralized betting platform Polymarket, the betting odds for a United States government shutdown have reached an all-time high. The probability of a United States government shutdown in 2025, the odds for the yes side of this contract have now soared to 77%. Therefore, this has reached its highest level since the contract launched in January. That means uncertainty is rising significantly. Of course, personally, I think the possibility of a United States government shutdown is very low. Now, as we saw earlier, the United States economic indicators announced yesterday were really good. Unemployment claims, jobless claims, and Q2 gross domestic product all posted strong results. As a result, cryptocurrency investors hoping for more interest rate cuts had their sentiments shaken. That's how it appears. So, to sum it up, even though there was the great positive news of the Fed's interest rate cut, the reason the cryptocurrency market dropped was, first, because of leverage liquidation. Second, institutional funds began leaving. Now, this part is, of course, short-term, and there was also political uncertainty and macroeconomic issues. Lastly, as the technical support level broke down, some technical investors pulled out. So, because all these negative factors overlapped, you can see that we haven't been able to get out of the recent bearish trend. In my personal opinion, since the momentum has been broken in the short term, I believe there is a possibility of further decline for both Bitcoin and Ethereum. However, from a mid-term perspective, I see this decline as a valuable buying opportunity at a low price. Interest rate cuts are the best news for the cryptocurrency market. Nothing matters more. Therefore, as additional interest rate cuts are announced in the future, both Bitcoin and Ethereum will turn upward. So that's what I'm expecting. The last content prepared for today is today's United States stock video. Today's United States stock video features Gin Monster, who is one of the analysts I personally trust a lot. Now please check out the dubbed video to see how Gin Monster is currently analyzing the market and what views he presents on the future of artificial intelligence investment, which we all care about. That's it for today's United States stock news on September 26th. I sincerely thank everyone who invested in United States stocks with Mijung and me this week. All right, everyone, as the weekend begins, stock charts. Take a break from the stock charts for a while, relieve your stress, and focus on making happy memories that will last. I'll recharge well over the weekend too, so I can greet you again on Monday in good health. We're all white together until we retire from investing in United States stocks. Have a happy day, thank you.
It's always a pleasure to see Jin, the managing partner at Deepwater Asset Management. Several headlines have appeared in recent days. As an analyst and from the perspective of analyzing companies and stocks, how do you view these promises of guarantees and articles related to funds that have not yet been executed? And we still don't know what the return on investment for all of this will be. What do you think about that?
As you said, the main point is the funds haven't been used yet. Since September 4th, what's come out in the headlines and from the White House, there's a gap between Zuckerberg's mention of $600 billion, the adjusted figures caught on a hot mic, and Susan Lee from Goldman talking about a 45% capital expenditures growth outlook. The discussions between open artificial intelligence and CoreWeave, the collaboration with Oracle, Meta's repeated statements, news about CoreWeave, Oracle's announcements, and the open artificial intelligence and Oracle tour in Texas this week all point to what's coming in the future. The market is clearly impressed by what we've achieved so far, but I think real credibility is needed to go even higher from here. If we look at it from a slightly different perspective and take the directions that companies have announced over the past 3 weeks at face value, their valuations should be much higher than they are now. But the market is heavily discounting these growth prospects. In the end, the most important indicator is next year's capital expenditures. Meta, Google, Amazon, and Microsoft are all expected to see an increase of about 7%. However, if we reflect on what companies have mentioned over the past few weeks, capital expenditures growth over the next few years should be close to 50%. This is where a huge gap occurs. Melissa, considering the current market situation, it's understandable, but I still think there's a significant discrepancy.
Then do you think the discount reflected in some stocks recently is sufficient? It's because in addition to notes on growth, there are also external bottlenecks that could affect this growth, such as power supply issues. Even if all this demand exists and funds are invested in things like chips and infrastructure, there may still be a need for significant additional investment in areas that are not yet fully reflected in the current numbers, such as power generation facilities and securing electricity.
In the end, everything comes down to this. Melissa, we need to build up our power supply and infrastructure. These are all things that are coming in the future, and I think the hardest part for the market to handle is this demand for power and computing. NVIDIA has had some very good news over the past few weeks. Stock price rose over 1%, but Nasdaq stayed flat. Ultimately, it comes back to the idea of distrust about where we are ultimately headed. I'd like to offer a slightly different perspective on this distrust. If you look at open artificial intelligence statements this week, they raised their revenue forecast for fiscal year 2036 from $175 billion to $200 billion. There are still 5 years left, but if you look at the company's announcements, these numbers will continue to exceed investors' expectations in the future. Of course, considering the elements needed at the level of infrastructure development you just mentioned, it's understandable. But in the end, this will be realized. I don't think it makes much difference whether this expenditure happens in 2028 or in 2032. The important thing is that artificial intelligence will bring dramatic changes to our lives, and these companies will benefit from it. Lee?
Start with a small dream to plant seeds for a hopeful future together. Each day, it grows a bit more. Is excitement blooming in your heart? Release your greed. It won't be any different this time either. The result continues the process, even if challenges arise. I'm not afraid and will move forward with Miju. I'll become the light of tomorrow that can be seen. Happy investing, supporting each other's dreams. Let's walk together down this beautiful downhill path. Happy investing with Miju until the day we all boldly retire with national stocks together.
sometimes quite